See all of you again. Here, I guess I'll sit here.
Okay.
You sit there,
All
I'll
right.
sit here. And we'll leave this one for Hamlet's father. Jason, Office of Strategic Capital. I don't think everyone is familiar yet with what that is, but it is an office that is going to kind of revolutionize, in many ways, the way we as a society prepare for great state competition. And it's also going to potentially bring new technologies into the Defense Department. What is it? Tell us a little bit about what you do.
So the Office of Strategic Capital was established in December of last year. So if you haven't heard about us, it's probably why. But we were established to provide the department new tools to compete in today's current global technology competition. And the job of the office is to attract and scale private capital and support a national security. But we were really born out of things that are not so new. I mean, this strategy and the series of things that the office is doing today to support the secretary and support the department reside and rely on things that we've done in our history. Mm-hmm. This country has gone through a long line of programs and policies where we've partnered with capital providers, with investors, with companies to create partnerships around things that we thought were really important. And this is just the next iteration of that, where we're partnering with technology investors and technology companies to increase investment in those areas of our economy that we think are most vital to national security.
Okay, so when we talk about the Defense Department and its partnering with investors in technology, I think back to sort of like the Ash Carter years and some of the things that he did to kind of stand up workarounds to get around the fact that the Defense Department was kind of bad at bringing in IT and non-traditional kind of startup players into the Defense Department enterprise. So we stood up the Defense Innovation Unit, which was then the Defense Innovation Unit Experimental. And across the department, you also had things like the Rapid Equipping Force, et cetera. And all these things were kind of workarounds to the fact that the Defense Department was trying to buy software the way you buy tanks and boats and ships. It's bad. What you're doing is very different. It's actually much broader in scale and kind of touches on much more of the entire economy. So tell us a little bit about what that scale difference is and why it's important.
Patrick, Ash Carter wrote this, was co-author in this book called Beyond Spinoff. It's one of my favorite books. It's very dense. It's written with a bunch of economists from Harvard and MIT. But in that book, back in the 1990s, Secretary Carter is really talking about these trends in the economy mm-hmm. that are telling us, if you're listening, us being the taxpayer, that the world's best innovators, the world's best technologists are outside of the DoD fence line. Right? For so long, we've had this concept with a defense budget that was driving science and technology forward. And even in the 90s, he was seeing a shift away from the government-backed capital of investment being the dominant source of investment capital going towards technology companies. That fast forward to his tenure as the Secretary of Defense, starting the Defense Innovation Unit, which led to this explosion of innovation organizations. I was fortunate to be part of AFWorks, which is the Air Force's innovation unit, and I got to see firsthand out in Silicon Valley the birth of DIU. The iterations of that really were focusing Ash's, I think, a big strategic imperative around, to your point, accelerating commercial technology that, for 20 years since he wrote that book, was outpacing the department's ability to innovate in many of these commercially driven areas where private capital was pushing investment towards mm-hmm. things like software, right? Where the consumer markets were far larger than the defense market. And so, of course, you're going to see more companies and more technologists and more engineers and more scientists working on things where there's just a larger market. We're in a capitalist society. That's where we see the pace of innovation being driven, whereas they're going to be generating the biggest returns. What we have also seen over that time is that the shift of capital has continued to move away from things that we consider very critical to national security. Right. Hardware-based technology areas, things like quantum or biotech or advanced mm-hmm. materials or semiconductors, right? The CHIPS and Science Act is a clear example of the US government saying, look, we're not doing enough in our industrial base today, in our economy today, to invest in these really important technology sectors that are so vital to national security. And the Office of Strategic Capital was stood up to really target on that fundamental issue. Where we have gaps in capital flows today in our economy, 92% of all venture capital today goes towards software-based industries. Right. You know, 20 years ago, it was 55%.
Right.
And so this has been a precipitous decline away from investing in these deep technology areas, which we think are not only vital to our military capabilities, but to our everyday lives. You know, going back to semiconductors, we all directly felt, not as the Department of Defense, but as taxpayers, as consumers, the impact of the semiconductor shortage.
Right.
Right. Whether that's a massive rise of the price of cars or inability to source critical components for many of the things we use in our everyday lives. You know, that is something that is, I think, universally felt, and that's why we in OSC think that national security and economic security are fundamentally linked in these domains. If we don't have a strong source of supply, a secure source of supply for these advanced technology areas, if we're not able to advance these industries in rapid ways that support not only the military but our broader economy, then we can continually be eroded by our inability to produce these critical technologies domestically.
So what are the key areas right now where there is an enormous national security need, but where venture capital investment has not yet attracted, where you feel like you can make a big difference? What are the big areas?
I think a couple of things. One, you know, the Office of Strategic Capital is focused on private capital writ large, right? You know, today we see trillions of dollars in our U.S. capital markets sitting on the sideline.
Trillions.
Trillions. The fact of the matter is that U.S. private capital markets, not only venture capital, but private equity, institutional financing, are the largest and most liquid in the world, right? It's not a problem of not having money in this country. The problem is where is that money going, and is it going to the areas, from our perspective, that we think are most important to national security?
Right.
I think for OSC, when we talk about what are these areas, we rely on the department's critical technology areas, which is a list of 14 technology areas. They span everything from things I was talking about earlier, biotech, quantum, semiconductors, through towards things that are very defense focused, like hypersonics or directed energy.
Right.
And one of the first things that we're doing with OSC in our initial stand-up phase is assessing these critical technology areas by a few key principles.
Okay.
One is, what is our comparative advantage as a country in these technology areas? The second is what is the availability of capital to invest in these areas? Okay. And the third is, well, what is the utility? What is the military utility of these technology areas? And from that list, there's going to come up a list of identified and prioritized key industries within each one of the technology areas that we think are of highest priority to the office, of highest priority to the department, in ways that OSC can help, right? And I'll give you some left and rights. You know, we've seen an explosion of investment in artificial intelligence, right? Like the growth.
It's software based. It's easy, big return on investment, low capital.
Absolutely, and things like generative AI have massively increased the amount of investment in the last 6 months. So that's not really an area that we think we're going to be investing a lot of our time and energy into, right? The department should absolutely take advantage of these advancements in artificial intelligence and in autonomy, and is doing so across the services today. But that's not where we see undercapitalization happening. Simultaneously, there are going to be parts of things like hypersonics or directed energy that we're not going to be able to drive market participation in a massive way, at least in some key industries, because in those key industries, the department is the only procurer, only buyer.
They won't sell me a hypersonic, I've asked.
So it's really this kind of middle ground of technology areas that we think are undercapitalized. One that that always comes to the top of the list as we think through technology areas that are vital to national security is quantum, right? I mean, you know, the administration releases executive order around the importance of quantum for national security. We see our allies and our partners investing heavily in quantum. And it's one that we think private capital markets have shifted, U.S. private capital markets have shifted away from investing in. Right? Capital market conditions today, it's no surprise to anybody that we see the capital starting to constrict, right? Venture funds are shrinking their fund size. Private capital is moving away from capital-intensive industries, and quantum is a capital-intensive industry that doesn't even really exist yet, right? We don't have quantum services on our phone. I was joking with some of the folks backstage. It's like, you know, we may think like quantum technology is going to be in my kid's iPhone 19, right? But it's not here today, and so there's no market. We're not buying it. but we know that we need to attract and increase investment in those areas. So it's those types of technology areas that we're going to be focusing on.
And that's an area where, like, right now, I can't think of exactly how quantum is going to revolutionize computation for everybody. But in theory, if you have it where within a military construct, if you can get it distributed so that you have individual operators, maybe it's on an aircraft carrier, maybe it's in a truck, then you don't have to worry about having to reach back to the Amazon Web Services cloud to run all of your joint all-demand command and control operations when you're moving like heavy formations. So there's that application. But in the commercial world too, I mean, could potentially revolutionize everything we understand about computation, right? And then you create, especially when you look at how energy intensive and server intensive all of these generative AI models are, and you look at the demand for them go through the roof, you're looking at a lot of server burn, a lot of very environmentally not friendly use of old paradigm computers, and quantum could revolutionize this. But so how do you bring everybody that has been burned by capital-intensive industry and is now getting burned by low capital-intensive industry as tech companies do layoffs and as they like look at their prospecti, how do you bring them to the table to begin to invest in something like quantum, which could change life on this planet, but right now doesn't have a strong business case?
Exactly to your point, there were a number of funds in the late 90s, early 2000s that started very what we call vertically integrated investment thesis around things that they thought were really important to some social good, right? There's a very famous fund that was raised by Kleiner Perkins around green energy that was widely considered a failure, ultimately a failure as an investment fund. They invested in great companies. The fund generated a return, but it didn't generate a return to the extent that there weren't other opportunities that same fund could have invested in, right? That fund could have invested in a number of companies in the 90s and 2000s, which are now massive powerhouses, right? Generated a much stronger return for the venture firm. And so there is certainly still to today a lot of firms and investors that are very rational, we talked about this before. The U.S. capital markets are the largest and the most liquid. Why? Because the U.S. investors are the best in the world, right? And I think the outcome of that is that we have to realize is these investors are going to invest in things that are going to generate a return. Right. And not just generate a return, right? But generate the highest return that can possibly be generated based upon all of the opportunities that exist in the market. Yeah. So I think when you look at how do we do that, we take a page from the book. The last time the U.S. government did this, and did this very successfully, which Sputnik crossed our skies in 1957. The Eisenhower administration had three things to better compete with the Soviet Union. The first was created DARPA. The second was create NASA, and the third was create the SBIC program that nobody really knows about or talks about. But the SBIC program created the venture capital asset class, right? The venture capital wouldn't exist today without the SBIC program, because the SBIC program provides government-backed debt to private investors to increase leverage on their investment funds in a way that generates stronger returns for those who invest in things that the government's interested in. And at the time, it was things like semiconductors, right? And so companies like Intel and Apple and Sun Microsystems were all invested in by SBICs, and that catalyzed this entire industry. And there's countless examples of companies that supported the national security apparatus that were also commercial successes that are well documented around investors that were backed by the U.S. government. And for a lot of reasons, in the 1980s, we shifted away from investing in early stage equity companies. We shifted away from investing with a prioritization on national security as we headed towards globalization. And I think what we've realized now is that as these things have happened, we've seen the capital markets continue to shift away from these very capital intensive industries. And so the theory that we have today, and it has not been proven yet because we haven't actually been able to implement the programs yet, those are coming the next few months, is that we, in partnership with the SBA, can bring back some of these same tools, right? Bring back some of these same ways that we've worked with investors in our history to partner with private investors, with capital providers, to drive capital towards those areas that we think are most important to national security. Sputnik,
I think, it's such a good anecdote. There was a group of folks at ONR that they could pick up like the pinging noise of Sputnik as it was circling. And they were like, oh, wow, you can sort of see where it is in the sky. And someone said, hey, I wonder if we could do the reverse. If we can pick up that signal and instead figure out where we are relative to it. And that is the basis of the science that led us to global positioning and GPS. I think so. Yeah, thank goodness for Sputnik. Otherwise, God knows where we would be. Like literally, I would probably be lost. But I want to go back to something that you talked about earlier. You have a new in March, SBA and DoD signed this joint agreement to drive critical technologies in the U.S. So what does that relationship look like? And when you go out and you're beginning now to talk to people in this $1 trillion that's sitting on the sideline, trillions, what sort of reception are you hearing from them? What are they asking and what are you telling them?
I mean, the partnership with the SBA has been incredible. You know, the SBIC program has been around since 1958, still exists today. Mm-hmm. It's primarily focused on this thing called mezzanine debt structures and corporate refinancings, but the SBA has it in their charter to pursue interests of national security importance. And I think there's just a great opportunity in the administrator and the secretary sat down in December when we launched the office to make this our first big program within OSC. Mm-hmm. With the SBA, we've been working on a rule change to make the SBIC program more equity loving, meaning that the SBICs or government-backed investors can invest in companies that are earlier stage, that are more risky mm-hmm. in nature, and that has gone through an incredible, a long process, but very well thought through process with the executive branch to finalize that rule. We hope that's done in the next few weeks. In conversations with investors through that rulemaking process, it's been very interesting to get their reactions. There is certainly I will be honest, the starting point of many of these conversations is the Department of Defense needs to be a better buyer. That's how you can work better with investors, right? I'm sure anybody who's been in this space has heard that, right? I've heard that for years. I've spent years of my career working on some of these issues. But going back to our earlier question, nobody ever says we're going to put semiconductors in the hands of our warfighter, right? Nobody's writing a requirements document for rare earth magnets, but we ground all of our F-35s because we find out that the source comes from China. So I think there's many of these fundamental industries that are vital to national security that a demand-driven policy, it doesn't really affect. And so once you get past some of those barriers and you say, okay, well, if that's the case, I still need to be able to figure out, like, how do I convince my investors, people invest in me, that I'm going to invest in a semiconductor company or a carbon nanotube company or a metamaterials company that is going to cost me 10 times as much, right? We talked to one investor, they said the average Series A investment for us in a semiconductor company is $40 million. Mm-hmm. The average Series A investor, the average Series A for a fintech company is $5 million. Why would I ever do one semiconductor deal when I could do 8 fintech deals? And that's just the cold, hard math. Right? And on top of that,
3 of them can fail, and all you need is one, and then you make your return like immediately.
7 of them can fail, right? And one can kind of succeed, and it still is a massive fund returner. Because the multiples that you get on software-based business models are far larger. Because of that, the public market values them much higher. And that's how you generated return as an investor. So as an early stage investor. So the way that we look at this is okay, well, let's provide government-backed leverage, right? Leverage is a concept that's commonly understood in the private equity markets, and it's one that we use in the government. The SBIC program is a fund leverage program. It's been around for 60 plus years. And through this leverage, what we'll do is we'll come in partnership with you. For every dollar you raise as a private investor, we'll bring in some amount of government-backed financing, meaning government-backed loan that you can get from a private banking institution that's backed by a government guarantee. And combining this private equity that's raised in the private capital markets and government-backed debt, you have now more money to invest in these areas that we think are important, so you can do more capitalization. And that government-backed debt is non-dilutive, right? So once we return the debt, all of the profits go back to the investors. So what that creates is a multiple on IRR, or any type of metric by which you're going to assess fund performance. It's like, the best way I can explain this is buying a house, right? If you have $100,000, you can either buy one $100,000 house, or you can buy 5 houses and put a $20,000 down payment on each house. And if they all go up in value, right? If you bought one $100,000 house and it came out at 10% in value, you make $10,000.
Yeah,
right?
so you can see how this is actually an enormous culture shift for our government, because our government does invest in very early stage technology through grants, where they don't ask for any return on investment whatsoever. You're just giving research scientists money to do research science. We do invest in safer companies, but that are sort of further along. But there was you now had to push for a rule change to allow the government to invest in earlier stage companies to buy down risk, but where there's still a return on investment, and that was huge. Like that's actually. And first, it's a sign of how our economy wasn't set up well for competition between the United States, China, and Russia. But it's also an example of a relatively small change that seems very intuitive, but one that you had to push for.
I think the best way to think about these programs, counter to other ways of partnering with capital providers or directing or controlling capital providers, is these are incentive-based programs, right?
Right.
Investors can choose to opt in or not. We'll take a product to market. If people want to buy it, it's an incentive for them to partner with the government to invest in areas that we all think are really important. And again, we think generate returns, right? There are IPOs, there are successes in these deep technology areas. It's just that they're not as high as your Instagrams, right? And so as a country, we have to come together and say, okay, well, do we want to generate some incentives for companies, the investors who are going to invest less in these areas that we think are less vital to national security, and invest more money in these areas that we think are vital. But I wanted to highlight the point that you just raised is these are investment programs. And we say investment all the time inside of the Department of Defense, but we don't really mean investment, right? Every dollar that we spend today inside of the DoD is a dollar spent. It's what we call 100% subsidy, right? It comes out of the taxpayer's wallet, and we spend it on something, and we need to, right? Like, to be honest, we're not going to be able to loan or invest equity in a fighter jet, right? Because we are going to have to buy the thing anyway. But our point is that many of these core technology areas, these enabling technology areas, are pervasive in the economy. We don't actually have to spend money here. We can invest. Not only can we invest by ourselves, but we can invest with others, right? So there's these incredible multiplier effects. And everything that we're doing in the office of strategic capital, we expect a return on, right? We're not going to make an investment that we don't expect a return on. But there is a long history, and I cannot stress this enough, a long history inside of the US government of us doing this, right? There's 118 federal credit programs today. We talked about mortgages. The VA home loan program is a federal credit program. And so these programs that issue debt or do some type of investment in the commercial space, on average, cost the taxpayer 1.2%. Meaning that instead of like a fully subsidized budget, like the department's budget today, that these programs, where for every dollar spent is a dollar from the taxpayers, for the commercial loan programs, for every dollar that's spent, it's only cost taxpayer a penny. Right?
So in theory, this should make this entire endeavor politically safe, as the things that politicians fight about is spending, right? How much is government spending? Are they spending the right things in the right places? You're talking about return on investment. So it's the opposite of spending. It's actually like creating revenue. Do you feel as though when you talk to people in Washington, D.C., kind of across political lines, that there is unified bipartisan support for this concept and that they get it?
I think it's been our conversations with the folks in D.C. and with the Congress have been phenomenal. I mean, I have to say, it's the biggest thing that involves many of these conversations are, especially on the defense side, is teaching people about these programs. Like I said, there's 118 federal credit programs. There's only 3 departments that do not execute federal credit programs today: the Department of Labor, the Department of Justice, and the Department of Defense. Right? And so I think most of our time is just spent on education around these concepts, being comfortable with these concepts, but there's guiding regulation, there's codified processes and policies. The SBIC program we talked about, it's been operating for the last 30 years without any additional appropriations, meaning that they've been affecting change positively for the American taxpayer without actually costing the taxpayer any money. And the way they do that is by pooling capital, charging fees, doing things that you would expect a financial institution to do, but doing it focused on areas that we think are really important to society. And so to your point, I think these are well received. They're just fundamentally new concepts. And so the Department of Defense today still does not have an authority to issue loans, right? We don't have a DoD Title X federal credit authority. But there's been a lot of great conversations with folks on the Hill, and I'm confident that we'll continue to move forward in the right direction. Until then, DoD needs to learn itself, right? We've never done this before, which means that we've never done this before.
Yeah.
We need to build the talent, the expertise, the experience, and so partnerships like that, like the ones we have with the SBA on the SBIC programs,
Yeah.
partnerships that we hope to be announcing in the next few months are ones where we in the DoD can continue to learn and become better experts in these tools.
Well, let's skip ahead the next few months. What are the partnership landscape looking like for you in terms of, to the extent you can talk about it? You've also got international money. You've got money from allied governments that are interested in many of the same defense priorities. And you also have a lot of different players in the United States. What does the partnership landscape look like beyond just like the U.S. Capitol? Where else might we begin to look for people that are interested in investing in this endeavor?
Well, I think the interesting thing is that many of our allies and partners already have some type of investment vehicle that's focused on national security. The UK has the NSIF program, National Security Investment Fund. The Australian government is launching a critical technologies investment fund. And many of these different partners and allies are very much focused on investing in areas they think are important to their economy and to their national security. I mean, the best example of a public-private partnership, perhaps in the history of the tech ecosystem, is TSMC. Right? I mean, TSMC was a partnership between the Taiwanese government and private investors. Right?
Yeah.
Half of the money at TSMC came from private investors. The anchor investors was Philips, the parent company of ASML. Right? So, and in the 1980s. The Taiwanese government, in partnership with these private investors, pushed forward this entire business model innovation of purpose-built, designless, fabrication-only manufacturing, and did it in a way that the anchor investor was the world leader in lithography equipment, right? And manufacturing equipment. I mean, that is a masterful stroke. And then through years of TSMC's successful operations, continued to grow Taiwan into the semiconductor powerhouse that it is today. And I think when we look at OSC, we are very nascent here.
Yeah.
And so the best partnerships that we have today are ones that we'll continue to learn from. I mean, and I think we've seen this in partnership with allies and partners, with folks here at home, the Department of Energy's Loan Program Office. Yeah. Just to give you size and scale, right, today as nearly $400 billion of available debt financing. Export-Import Bank is $135 billion. The Development Finance Corporation is $60 billion. I mean, these are very scalable programs because they are programs in which we expect a return. Yeah. Right? So they aren't spending programs. Don't think of them like the Department of Defense's budget, but they can't do everything. We can't just go buy a thing with these programs, but we can invest where it makes sense and where it meets our standards of investment. Yeah. So sort of in closing, it's very tricky sometimes to really grasp the depth and the breadth of some of these concepts, but during the Cold War, about 2/3 of U.S. R&D money came from the U.S. government, and about 1/3 came from the private sector. And at some point after the Cold War was beginning to wane, that's shifted. And so you saw this big effort from the Defense Department to reach out to the private sector because that was where innovation was coming, because that's where the R&D money was coming. And they were doing great stuff with software, but there wasn't the capital or the return on investment from some of these harder issues that was there. And so now, what we're talking about is actually the first steps to recreating the entire US economy to be competitive for this race that we all understand that we're a part of in a way that's sustainable across administrations and that actually makes money as we are better prepared for this competition. So we will all be watching very carefully to see how you're going to bring quantum computing to all of our phones in the next few years and new breakthroughs in biotechnology and what new microelectronics factories might be opening up down the street, and I know that that's a big part of your future. But in the meantime, thank you so much for joining me on stage today and being part of Tech Summit. Thank you.
Jason. All right.